All right. Looks like we are live, ladies and gentlemen. Thank you, everybody, and welcome to our live Q&A. And today we're planning on discussing what is going on, broadly speaking, in the macro markets today and the impact specifically to the managed future strategies of trend and carry. And if you guys haven't heard of us already, my name is Rodrigo Gordillo, President and Portfolio Manager at Resolve Asset Management Global. And today I'm joined with Corey Hoffstein, Chief Investment Officer of Newfound Research, along with Adam Butler, CIO of Resolve Global. And everybody here today are co-founders of the Return Stacked ETFs and Return Stacked Portfolio Solutions Ventures. So thanks, gents, for joining us today. And we turned this around quite quickly. I know everybody's been hard at work trying to get a handle on what's going on in the markets in the last few weeks and days. I'd like you guys to help us set the stage a little bit on what's going on in the markets. I mean, in the last few weeks, we've had European regulation reforms, the surprise German fiscal stimulus, the Atlanta Fed's negative Q1 GDP now print, not to mention the tariff battles, between Canada, Mexico, and Europe. Now we have the reality is that systematic managers that we generally don't talk about these fundamental things very much, but I do want to kind of pick your brain because I know we talk about it a lot internally. What have been the biggest market moving stories in the recent weeks? Who wants to
Hey,
take
Rod, I want to point out you said all that's happened in the last couple of weeks. All that happened in the last 3 days.
Yeah.
So I think it's just that every day feels like a week. Look, to me, these are all big stories, right? Tariff pressure leading to a massive -1 Q1 GDP forecast print is huge for the US economy. These European regulatory reforms are huge for European growth prospects. But to me, the big one that was a surprise and feels like a bazooka is the German fiscal stimulus. For folks who haven't read about it or looked into it, the proposed fiscal stimulus is really focused on infrastructure and defense spending. And in particular, it allows Germany to lift their budget cap for any defense related spending. And so the amount of fiscal stimulus that it captures is between 10 or 20% of Germany's GDP. Right. So to put that into context, that's about how much the US unleashed as a percent of GDP during COVID, right? When we shut down the economy, we did a fiscal stimulus package of 10 to 20% of our GDP. Germany just went, let's do it. Right. And so you saw massive moves in the German bund, right? Rates there jumped 30 bips, which is the last time they jumped 30 bips was again during COVID, during expectations that the government was going to have to pay for this somehow. You saw huge moves in the German DAX, right? The equity market, both up and down, right? Lots of volatility there, right? And you saw moves in the euro versus the dollar. And so I think in terms of like something that had a true cross market impact, that was just a huge one. And the scope of it for Germany is just so massive relative to their GDP. It feels, I feel like we use the word unprecedented every time something happens in the markets, but for not having a COVID-like economic shutdown, to just say we're unleashing 10 to 20% fiscal stimulus is huge. Now,
I think it's
people
also
should be aware.
underappreciated. I think it's
Just
also
gonna have one
underappreciated.
comment real quick,
Yes,
Adam.
yeah.
It's not in effect yet. I think the vote is March 24th. So in terms of what markets are trying to digest, there's also a probabilistic reaction here. And if markets overshoot that this is going to get implemented, you could see a whipsaw effect in late March.
Yeah, I actually, just in terms of whipsaws, I mean, this has been an environment dominated by whipsaws. I remember coming into February, the tariffs are announced. The currencies of the target economies are decimated, which was in the direction of carry. It was in the direction of the prevailing trend. Started out being a phenomenal day, February 1st. And by the end of the day, it was, announced effectively that the tariffs were not going to come into effect, or at least they were going to be delayed. There were options for target countries actions they could take in order to avoid this outcome. So markets completely reversed. And we've seen these kinds of policy reversals over and over the last few weeks. And it is this strange binary outcome, right? 25% tariffs or on Canada and Mexico, on top of 20% across the board tariffs to China. That is a completely different global world in 6 to 12 months than not having those tariffs in place, right? So investors are having to sort of price in this double-headed, this binary distribution where, you've got to price in the probability of one or the other. And it's not like it can be the average of the two. It's going to be one or the other, and markets are just vibrating between them, right? Just in terms of the size, the magnitude of this change in Europe, legislation was put in place on the formation of the European Monetary Union to enforce fiscal prudence, largely driven by the Bundesbank, by Germany, which is typically the most austerity or fiscal prudence oriented country and governance structure. But it was applied broadly to the Eurozone, broadly to the EMU. And those rules are not easily overturned. Some of them require unanimous consent from all EMU participants in order to pass. So, while Germany has changed their views, obviously, 180 degrees over the last few days even, we still need the Scandinavian countries also need to validate any major changes in rules. It also takes a 2/3 majority to change the laws around the debt brake in Germany that would allow them to engage in this level of fiscal expansion. And keep in mind, this is 10 to 20 times the level of fiscal expansion that is currently allowed under Germany's debt brake policy. So it's not just that, the politicians have announced their objectives or their goals or what have you. It is there's the markets are saying there's a reasonable probability that these rules will get completely repealed or substantially modified in the very near future, which will unleash a completely different economic environment in Europe. And that's what's being priced here.
Yeah. And I think, talk about unprecedented, the last time that the yields moved this quickly in Germany was 1990. So it's been a while since we've seen a single day move like this. So I just want to kind of go through, because we're going to be talking about systematic strategies. And, just as a reminder, systematic strategies in the managed futures space invest across all equity markets, or large swath of equity markets, large swath of bond markets, commodities and currencies. And I'm going to go take some time to go through some of the major ones so that we can get a feel for what type of the magnitude of moves in the last few days. And so why don't I begin with currencies here? The US dollar is up 8% against major markets from September to 2024 to January 2025, and down 4% from mid-January through to March 5th. That's the type of whipsaw we're seeing, right? That the UK currency is up 2.5%, and the euro is up 4% in the last 3 days, representing a 99th percentile and 99.9 percentile 3-day move, right? Again, this is going to be a common theme as I go through these.
Yeah, so just to put that in perspective, right? A 99.9th percentile move is expected to happen about once every 1,000 days.
Yeah. And so when I move on here to, what do we just do? The currencies, German bunds, we just talked about them, a 3% move in the last 3 days. That is a less than 0.1 percentile outcome. Gilts down 2% in the last 3 days, a 1 percentile outcome. Equities, the German stock market, we look at 25% increase since 2024. In the last 2 days, it's been incredibly volatile with a negative 3.5% on March 4th and a positive 3.5% on March 5th. All right, again, talking about these whipsaws. S&P 500 and NASDAQ, strong trends in 2024, now negative for the year in 2025. And we're definitely kind of seeing some short-term shift in momentum away from U.S. equities and towards European equities. On the energy front, we're looking at very strongly positive 10 to 20% moves across a variety of contracts. from the lows in September 2024 through mid-January. And the Brent crude move in the last 3 days of negative 5% is in the 5th percentile. Most energies are now negative for 2025, with the exception of natural gas, which is up quite a bit. It's up 35%. All right, metals. Trends in gold and other precious metals are generally strong from 2024 through 2025, even to date. Copper, this is the big winner here, is up 15% year to date that's like a massive, big 1 day 5% move. That's a 99.5 percentile outcome, right? And that's due to the tariffs, right? That were announced in copper. I don't know if people knew that's another announcement that has come. We focus so much on equity markets, but we are
One can be excused for missing a policy announcement amongst the barrage we've been, yeah.
And then in grains and softs, the big movers were coffee up 15 to 25%, and cocoa down 30% year to date. Okay, so those are the markets we're dealing with, and that's the magnitude. And again, focusing on how rare these moves are, single day, 3-day moves, as we move into assessing what those broad market impacts are to systematic strategies like carry and trend.
I think it's important to remind people, like listeners, when you talk about managed future strategies, many people don't realize that we're allocating to all of these different markets. Like the reason why we're talking about how cocoa and copper and the DAX and the Bund and all these different markets have been behaving is because these are, for the most part, constituents of managed futures portfolios, right? So while typically investors' attention is on what's going on maybe in the S&P, or maybe some are watching the US 10-year rate and maybe the dollar, so really need to take a global multi-asset perspective.
Yeah, that's a good point. So let's start talking about some of these managed future strategies. Let's start with carry, multi-asset carry to be specific. Not everyone is really as familiar with carry as with multi-asset carry models as they are with trend. So Adam, you literally recently wrote a large white paper for Resolve on carry. Can you give us a 30,000-foot review as to how the strategy operates?
It's not that large or intimidating, definitely digestible and approachable and worth reading. Yeah, I mean, there is a reason why we parenthetically call carry yield, right? Carry is the return you expect to get on an investment if the price doesn't change. I mean, obviously we're used to in this environment getting the vast majority of our returns from changes in prices, right? Stocks go up, indices go up, et cetera. But there is another source of returns, and that is yield. In equities, it's the dividend yield. In bonds, it's the coupons that are paid quarterly or biannually or annually on bonds. In currencies, you can borrow in a currency with low interest rates to invest in the short-term government bills of a currency or a government with higher interest rates, right? So you can borrow at say 1% in a domestic currency, and then invest overseas in a country that's yielding 2% and earn that 1% spread in currencies. And then in commodities, there's also a yield, a convenience yield, a roll down yield. The idea in commodities being that the futures markets are helping to ensure large investments by commodity producers by giving them a price today for their production, which probably won't come online for many years in the future. But by the futures markets giving them a price today, they're able to lock in a much better financing rate on building out those large projects to build those into production. And therefore, their cost of financing is lower. The economics on these projects are more attractive. And so it's this win-win in commodity markets, right? So it's really just dividends on equities, coupon payments in bonds, interest rate differentials in currencies, and this insurance and convenience yield in commodities that we are harvesting. Again, the price doesn't really need to change, though in futures markets, it ends up that the price changes just in terms of how futures roll up or roll down the curve coming into the maturity of the contract. But the simplest way to think about it is just, picking up coupons or picking up dividends.
Okay. So, but let's talk a little bit about, so that's the concept of carry. But let's talk about the idea of those carry measures as signals to try to predict the future price movement of these assets.
Yeah.
Because I
So in
think
general, you want to be
people think we're
long.
flipping coupons in front of a steamroller roller rather than using it as a predictive measure.
Sure. The idea is that in general, you're going to expect to get a higher return from an asset with high carry. You're going to expect to get a negative return from an asset with negative carry. What is positive carry or negative carry? Well, typically, carry is whatever the rate of return is above the cost of financing, right? So you need to borrow money in order to purchase an asset. So if the rate that you are borrowing at is lower than the rate that you expect to get paid on that asset, you're expecting to earn a positive carry. So let's say this is actually not the case in many global equity markets at the moment, but let's say that the expected dividend yield on an equity index is 5%. And the current interest rate that you would need to borrow at in order to invest in that equity index, you only have to pay 2%. Well, you would expect that to earn about a 3% premium over the duration of holding that instrument, right? If instead, as actually is the case today, the dividend yield is actually lower than the financing rate. So let's say the dividend yield is 2%, it costs 4 or 5% to finance it. Well, actually, you probably want to be short that asset and long cash effectively in order to earn that differential, right? And so in that way, what we sort of assume or expect, and what's validated over decades of empirical evidence, is that markets tend to rise in price to match the expected carry, right? So if there's an expected 3% difference between the cost of financing and the coupon or dividend yield or what have you that you're expecting to get paid, then the price will sort of rise in order to deliver that 3% premium. Or in the case of being short, the price will fall in order to deliver that premium. And we're measuring that premium, that carry premium, every day, and it changes every day depending on changes in interest rate differentials or the slope of the yield curve, et cetera. And we're adjusting every day to try to get maximum exposure to markets that appear to have the highest expected carry and the largest short exposure to markets that have the greatest expected negative carry.
So, Rod, if I can summarize it maybe in like one sentence,
Yeah.
Right? Because I think what's important here, when we talk to people about carry strategies, they often think about clipping coupons. What's critical about a multi-asset carry strategy is it's using carry as a signal to try to forecast the total returns of each market rather than a strategy that's trying to isolate and extract the carry on its own, right? So just like trend, use a trend signal to go long and short markets and you're trying to forecast the total return. Carry strategies can do something similar.
Yep. So let's then, with that understanding, if anybody wants to get something a bit deeper, we've done a ton of other videos and papers on it, and you can go returnstack.com and read some of the blog posts in there. But let's talk about how carry has been affected in this market environment. So broadly speaking, how were multi-asset carry models positioned entering this week?
Yeah, so keep in mind, right, just think about the evolution of the economic environment since, say, 2020, right? So we had this large stimulus from COVID that contributed to a surge in inflation. You can argue about what other factors contributed, but a surge in inflation. We had the Fed raise rates aggressively, and therefore short-term yields rose above long-term yields. Now the yield curve is inverted. So that when the yield curve is inverted, you're actually getting a lower expected return on the 10-year than you are on owning cash. And so that implies from a carry standpoint that we should be short bonds, right? And indeed, the carry strategy was short bonds for much of the 2022, 2023 period, right? And through much of 2024. And then as the economy began to cool, the Fed began to, and global central banks began to talk more dovishly about rates, imply rate cuts, actually have rate cuts. The curves have normalized and in many parts of the world are now back to being upward sloping, right? So over the last 6 months or so, our bond exposure in the carry strategy has tended to be on average more sort of long bonds. Now, what happened, and by the way, as a result too, there were changes in currency markets as different economies experienced changes in or moderation in inflation rates at different rates over time, or at different speeds, let's call it, over time. And therefore, the currency markets changed in order to reflect those changes in return expectations and therefore changes in interest rates, short-term interest rates, right? So now we come into the most recent episode. The Trump administration announces that America is no longer in a position to continue to fund the Ukraine war, to continue to support NATO to the extent that they have. Europe is going to need to stand on their own 2 feet, so-called strategic autonomy. That motivates this enormous, basically overnight change in both the public's perception of the necessity of major fiscal spending policies in Europe, and changes to the legislation that would be required in order to actually operationalize those fiscal expansions. So the market goes from perceiving that Europe is kind of locked into this low growth environment because they've got all these regulations that prevent major expansionary policies. Overnight, that's flipped on its head. We're going to get massive expansion. Therefore, nominal growth expectations jump effectively overnight in Europe, and European bond markets are repriced higher in terms of rates in order to reflect these higher nominal growth expectations. So that was, as Corey mentioned, a highly irregular shock to both short and long-term rates on European government bonds to the tune of between 20 and 30 basis points, basically overnight. And as we know, when interest rates go up, bond prices go down. So we're long bonds in the carry strategy because the slope of the yield curve has been normalizing. In general, we're expecting positive returns over cash from holding bonds. We get this kind of overnight rate shock. That obviously is highly punitive. And that was the major explanatory variable in terms of why we experienced that large negative return yesterday. It wasn't just that, there were also sort of secondary effects too. As the interest rates changed between Europe and the US, there also was then, that made the euro more attractive as a currency for global savers to hold their savings in. So there was a flight from US dollars into the euro. So the euro rose. We were also net short the euro because the interest rates in the US have been structurally higher than in most of the rest of the world over the last 12 to 18 months. So we've been structurally long the US dollar and short foreign currencies. So we were positioned, we were short the euro. Now the euro kind of crashes higher, right? So that was also at the margin a bit of a hit. Add in the Trump tariffs, copper jumps. Meanwhile, copper is suggesting negative carry properties. So we were short copper on the wrong side of that. And oil is reflecting supply-demand dynamics where the oil market is in backwardation. So we're also offside a major collapse in oil. So it was just a kind of a constellation of large surprises that went against the prevailing tailwind that we normally expect to get on our carry positions.
So that's very helpful. Thank you, Adam. I think a lot of people in the last 3 days may be thinking, okay, this is the typical carry strategy that has a negative tail risk, right? This idea of the yen carry trade going against you at the worst of times. Do you think that idea is true here for multi-asset carry? What are your thoughts on this concept of of the picking up pennies in front of the steamroller for carry, broadly speaking?
Well, I mean, if you look back historically at recessions and the concept of kind of a typical pro-cyclical strategy, pro-cyclical meaning it does well when the economy is in an up cycle and does poorly when looks like we're falling into recession. So think sort of the reaction function of global equities. You just don't see it. So because we're trading all of these different markets, we're trading global bonds, global currencies, global commodities, and global equity markets. For example, we've been sort of strategically short on average global equities for many months, right? So, if sadly equities kind of didn't fall yesterday, right?
Yeah.
So that was also a strange situation. Equities are down today. The carry strategy is benefiting from that, right? But this is not a pro-cyclical type of hit on the carry strategy, right? If anything, the carry is getting hit by a major growth shock in the Eurozone, right? And if you look back historically, the carry strategy doesn't have any pattern. If it happens to be positioned in some bear markets so that it's kind of long equities or short rates, then it can get hit for a time while equities get hit. But there are lots of times when it runs in reverse and carry ends up being a wonderful diversifier by rising substantially as equities fall in bear markets. So there's just no clear pattern. I understand that many people who've been around markets for 30 or 40 years kind of think of carry as currency carry, where you're borrowing in, say, the yen or the dollar to invest in the Mexican peso or the Brazilian real or what have you, to pick up this interest rate differential against emerging market currencies. That is clearly a pro-cyclical strategy. It is in theory, it is empirically. You see them, they get hit when equity markets get hit. But because we're applying this concept to all these different markets and sectors, theoretically, there's no reason why it should have that profile. And empirically, we just don't observe it.
Right. But I think, look, we've had a shock. We've had a macro shock in the last few days. And we have seen periods where the carry strategy has been caught offside. Can we talk a little bit about historical context where the strategy is positioned against the policy shock, and then what happened after? Can we go through some examples there?
Yeah, sure. I mean, think about the 1994 bond massacre. So Greenspan, he's newly in office. He wants to set a standard as a hardliner. So he enforces this very large surprise interest rate raise, and that was actually the until this period the largest drawdown in the carry strategy. Just this unexpected major adjustment to in that case rates. It was rates again this time that caused a material decline. Took kind of a year or so to recover from those losses. Equities and metals also contributed to losses in that period. But eventually, because there's nothing changed about the long-term expectation of this premium, it went on to new highs. There were steel tariffs introduced in March of 2002. The carry strategy was caught offside. Some commodities in that year, and it struggled for a couple of quarters, but actually ended up 20% on the year. In 2016 to 2018, we also had, you'll remember, the Fed tried some policy normalization during that period, and then markets kind of had a temper tantrum in 2018. 2018 was a very rocky year. So when at the beginning, when central banks began this normalization policy and markets weren't expecting it, we had another substantial drawdown. That was also a round of tariffs on China. So another sort of similar context to the current situation. So carry experienced about a 20% drawdown then, right? And there was also kind of a post-pandemic inflation while the market was digesting what how the Fed was going to normalize rates after raising them, then it's been a kind of a bit of a sideways to down move, right? Obviously, in all of these prior periods, things normalized and carry went on to actually, in many cases, and kind of on average, to emerge from these troughs with a surge of better than average performance.
Yeah, that's what we've seen across every one of these as the very strong outsized recovery coming out of these situations. So that is important to understand here. But just going back to the last 3 days, a lot of people are asking, have there been any adjustments made? Is the system adjusting in any way? Can we talk a little bit about how often the multi-asset carry strategy described in your paper is adjusting, and then how the adjustments have happened in the last 3 days?
So we're looking at the changes in the interest rate differentials and the slope of the cash yield curve and the term structure of commodity futures, et cetera. We're looking at that every day, and we're making adjustments to the portfolio every day. And so, yeah, there has been at the margin some reduction in energy exposure, equity markets, metal exposures. There's been a marginal reduction in European bonds. What's happened is there's been obviously an increase in volatility, which at the margin would expect a position to contract. But because the yield curve has steepened in Europe, also the expected carry has gone up. And so to some extent, the expectation of higher future performance by holding European bonds has offset the increase in volatility. So there hasn't been a very large reduction in European bond exposure. There has been some at the margin, right? There's actually been a small increase in exposure to US bonds. But generally, the exposures in carry tend to change a little bit more slowly. Major changes to things like global yield curves, global currency differentials, et cetera, tend to happen over a period of sort of several weeks and months. And so we expect the strategy to adapt on those timeframes more than via overnight shocks. And if you look back on average over very short horizons after these types of shocks, that strategy has actually paid off, because you tend to see an overreaction in the very short term to this type of shock or this type of news. The market then moderates that reaction a little bit. So we tend to get back a little bit of what we lost. And then once the market stabilizes, the carry signals have also stabilized. We've got a better reading on the new regime that we're in terms of the carry portfolio, and we're better positioned for what emerges going forward.
Perfect. Okay, so that's a very good overview of carry, what's going on in carry, and how it's changing. Let's flip over to trend following managed futures. Corey, maybe you can help us out here, get some better understanding of what's been going on. Trend following strategies generally succeed when they catch these very strong sustained moves, and they tend to struggle in these type of reversals that we've been talking about. So over the last 3 days, why don't you give us an overview of which markets have contributed the most and why?
Yeah, and I think it's always interesting to think about when you have these big reversals. In some cases, in other cases, it's been substantial extensions of the trend. How much are those surprises really priced in versus how much was the market predicting? And we can talk a little bit about that. But just in terms of what we saw over the last couple of days, obviously gains in European equities were strong, though volatile. And we've been overexposed to European equities, largely underexposed to US equities, as US equities have been flat to negative over the last 3 months. We've been seeing a moderation of that position, while European equities have been very strong, plus 10 to 15%, depending on which market you look at. So we continue to see positive trends there. We've been long metals, gold, silver, copper, and continue to see strong trends there. Energy is one that we've been flat-ish, and it depends on particularly where in the energy complex. We've been, we had some gains in nat gas that were offset by losses in crude, right? And RBOB gasoline. So that's sort of a mixed bag over the last couple of days. Bonds, we've been short. And so while we're down year to date on bonds, because bonds have just been a struggling trade for the last, I don't know, call it 18 months almost, as they just get whipsawed back and forth by different with market digesting policy decisions and what's happening with inflation and economic impacts of tariffs. But we did get the benefit from bonds. And then probably the biggest loss was in currencies, right? We have been predominantly long the US dollar. As you mentioned at the beginning, Rodrigo, the dollar as a basket was up 8% last year. It's not a surprise we were long the dollar against a good cross section of other G10 currencies. And then we had these very rapid repricings, particularly in the British pound and the euro, that led to a pretty substantial, 1 or 2 day loss. Not substantial in knocking the whole portfolio off sides, but substantial in the size of that individual position.
And so since we've seen extreme volatile moves here in the last few days, have we seen any major adjustments in positioning as a result?
Yeah, and when we think about, again, we're evaluating trends every single day. When we think about trend following, there's two drivers for us. There's the volatility component, where we are volatility targeting these positions. So as volatility expands, we'll naturally reduce the size. Long will get less long, short will get less short. And if trends change materially, right, that can change the direction or moderate how much exposure we have. So, again, with weakening US equity and increased equity volatility, we've seen some of our equity position to continue to come down. We've actually seen a marginal increase in the metals as gold, silver, and copper continue to perform. We've seen a marginal decrease in energies. Trends continue to reverse from positive, and some of them are showing as negative now. We have increased our short bond exposure. Bond prices have been trending negatively since around September last year, and the trend continues. And so we'll press the shorts there. And we've been reducing long US dollar exposure. Now, reducing here, right? I think when we look at a couple multi-day changes, our bond exposure has jumped up 40%, right? But it's important to keep in mind vol of a 5-year treasury is very different than vol of equities. Currencies have dropped, about 20 percentage points, but again, vol of the euro is very different than vol of equities. So on a risk basis, there haven't been really substantial changes from these last couple of days, but as markets continue to digest the probability of these things going into effect, that's where trends can emerge, right? I think that's a really important point here is people often ask, why do trends exist? We talked about this 1-day change with the German fiscal policy proposal that has to go to vote. And Adam talked about all the potential risks of this going to vote. The market over the next month will start to price in the probability of realizing that. The first move was just recognizing that it could occur. And then as it becomes more or less likely, if it becomes less likely, that those moves will likely revert. As it becomes more likely, they might continue. And again, that's how those trends can persist as markets price in the probability of these bimodal events.
Right. So let's talk just the same thing as carry. Like historically, we've seen similar geopolitical movements affect trend in different ways. What lessons from those kind of past events can we apply to the price movement of managed futures trend today?
Yeah, not surprisingly, it's actually a lot of the same events that happened in carry were trend events as well, right? And it's because a lot of these events that catch their carry or trend offside, it's not because trend and carry actually historically are similar signals. They're actually quite dissimilar, and that's what makes them such a great complement. But it's because the policy or market shift has been so against the prevailing expectation that you get this sudden reversal in these markets. So, 1994, again, the interest rate event in 94 with a massive unexpected rise in rates caused trend to have a negative year. Steel tariffs in 2002, 2015 through 2018, just a struggling period for trend in general, as it was, sort of these ambiguous central bank decisions around the world as to whether they were or were not going to come off of the zero interest rate policy. Start and stop growth in global economies in the early 2010s, again causing struggles for a lot of trend strategies. And then 2021 to 2024, obviously 2022 was a very strong trend year, but then we had post 2022 again trying to renormalize trends to post-pandemic inflation. 2023 in particular being very tough in bonds. I mean, I think the majority of losses last year were in bonds, but we can highlight the move in the yen as well last year as being a big driver. a sudden surprise, a big sudden policy surprise that went against the prevailing positioning. The last thing I'll add there is while some of these moves can go against the prevailing positioning, right? The trend is your friend until it ends. You can still net make money on trend following, even if the end is a violent reversal. And if you look at a lot of trend following P&L last year, the yen was a violent reversal in August that caused a lot of pain. But the net P&L for the year on the yen trade was still positive because the performance was so strong before that. And so some of these can be very painful when they occur simultaneously. Trend actually hasn't really been that bad over the last couple of days,
No.
especially compared to carry. But again, some of these things when they are trend surprises can be painful, but you have to consider it in the position, in the context of the larger trend in P&L that you've generated over the last 6 to 12 months.
Yeah, and look, I'm just reminded of '08 when I was a very heavy investor in trend. We're talking about 3 days, and when Lehman happened, the volatility in trend was just insane over those 3 days, and it wasn't necessarily favorable. But again, this is the thing about all of these is that there's a period of adjustment, and we saw it in 2020 during COVID, right? That first leg, the trend happened to be positioned in the opposite of the prevailing trends, and so the first week or so, it had a similar reaction to what was happening in global markets, but then it quickly transitioned the other way, right? So the adaptability of this is something to remember. But in any given day, really whether we're going to be on the right or wrong side of a geopolitical move will depend broadly on whether that geopolitical move is in the prevailing trends or against it. So 3 days is not much. We got to talk about it. We got to put it into context, but let's remember the big picture ultimately. So let's talk a little bit about just kind of comparing this trend following and multi-asset carry. They're both trading the same contracts. Why do we have those two different signals, and how do they tend to relate to each other, especially when they react slightly different to global macro events? Anybody grab that one?
I mean, they're mechanically similar insofar as we're broadly trading the same universe of markets. We're broadly finding an optimally diversified portfolio of those markets based on the trend and or carry signals at the end of every day. And they're systematic, right? And the other thing to recognize that Corey has hinted at is that systematic strategies, at least the ones that carry and trend rely on, are relying on changes in prices. For a trend, it's the change in effectively the rolled front month futures contract. For carry, it's changes in the prices of contracts along the curve, the futures curve, or along the spot curve. But we're taking signals from the market itself. So, as market participants are shifting capital away from one market and toward another, trend and carry are picking up on that. Why do we rely on that? Well, it's because we do assume that at the margin, participants making decisions in markets on average reflect information, right? So we're picking up on the information that the market is transmitting via its price movements. And just by virtue of the fact that these movements are basically impossible to decipher narratively or using some kind of clinical framework just in your mind, we're forming portfolios based on all these different signals across 27 different markets, right? But it's all just reacting to or digesting information that the market is giving us. So when the market is not doing a very good job of adjusting because it is confused or uncertain or doesn't know what is likely to happen, these are the periods when the trend and carry strategies are most likely to suffer. And that's exactly what we're seeing today. We're in a period of extreme policy ambiguity, right? We won't always be in a period of extreme policy ambiguity. Once that sort of settles out, either the market will get used to the way that, for example, Trump communicates and be able to, read the tea leaves and anticipate what his true intentions are and adjust towards that sort of over the intermediate term, or just, Trump may get what he wants, and therefore there won't be the same number of these policy changes happening. But at some point, the market will adapt to the new environment. There will be a new equilibrium, and these strategies will continue to go on and do what they've always done, which is just deliver on this nice uncorrelated premium.
So let's just kind of discuss, the difference here between market moves on headlines. Just kind of wrap it up, really. What are the strategies? The strategies operate on principles, and the question is whether recent returns are a feature or a bug. And so, which is it? Like, is this a feature or a bug? What we're seeing in these two strategies?
Yeah, right. So we have these systematic strategies that we talk about trying to harvest these premia that we believe exist, right? Trend following and carry, and we believe that there are, particularly with carry, I think there's a very strong argument that that's tied to intrinsic risk premia that exists in the market. Carry, a trend, you might argue there's some risk premia there, some behavioral, right? But they can be caught offside by these sudden market headline movements. And I think that's just the reality of any investment strategy. Certainly, it's never fun for something like a carry strategy to be down 5% in a day, or 5% over 3 days and 4.5% in one day. But we see that happen in other markets, right? Not just alternative strategies. We've seen that happen in equity markets frequently. We've seen that happen in bond markets, rarely over the last 20 years, but it has happened, right? And those sort of things happen when there is the market is fundamentally repricing something that it didn't get right. And a strategy can do the same thing, where the strategy can be offsides because, again, in our case, if we're trend and carry, relying on market-derived signals, and those market-derived signals are just not capturing or didn't anticipate these sudden, rapid, in this case, policy changes. So the reality is it's a feature, right? The thing I always say is if a strategy becomes too easy to hold over the long run, everyone would hold it and all the premium gets squeezed out. It's not a fun answer. It's a little flippant, frankly. But, I've said time and time again, no pain, no premium. If we believe there's a risk premium here that's different than equities and bonds, we should expect it to behave like equities and bonds. And no one really questions equities dropping by 5% over a couple of days. It's happened. It'll happen again in the future. But when it happens in alternative strategies, the sudden question is, well, is the strategy broken? And I think a lot of that just comes from a lack of transparency in these strategies. Going back to the beginning of this call, we rattled off all these markets that impacted carry, especially, right? Carry just fundamentally this week was on the wrong side of 3 or 4 massive policy announcements that came out of nowhere, right? You got the Canada-Mexico tariffs, you got the copper tariff, you have European deregulation, you have the German fiscal policy announcement, all happening in a 2 or 3 day period. And carry was on the wrong side of all of those. And that's unfortunate, but a lot of people don't even realize when they're investing in a strategy like this, because again, it changes over time. They might be long the DAX, long the dollar, long German bonds. That's where the beneficial diversification comes in, hopefully over the long run. But that can cut in the short run as well. And so it is. I don't want to say losses are a feature, but losses are a reality.
And so are large positive gains that offset losses in your traditional portfolio that we don't talk about much, because everybody wants to focus on what's going, quote unquote, wrong. The wrong is the pain that you're paying for that premium. One of the questions here was, the drawdown in carry has recently been pretty large. And one of the biggest challenges for advisors here is to help clients stick to strategies through different market environments. And a good way to set expectations here, and I bring this up over and over again, is, look, you're taking risk. You are taking risk in equities, you're taking risk in bonds, you're taking risk in a carry strategy or a trend strategy. A good rule of thumb for me has always been, what are my expectations of the best and worst? Let's focus on the worst here, right? So if you have a strategy like the carry strategy that we discussed has a kind of an average volatility or a standard deviation of around 10%. Well, I think the expectation here needs to be that there will be a -3 standard deviation move in that strategy. It is broadly normally distributed, and you need to expect those types of moves to happen every so often. It happened back in 1994 during the bond massacre in '94. It happened in the mid noughts, and we're seeing a little bit of it again today. And what's a 3 standard deviation for a 10% volatility strategy? Assuming a Sharpe ratio of 0.5, that's a 25% drawdown is a 3 standard deviation, right? It's probably going to go plus or minus that at some point. That's the risk. That is the kind of the long-term risk that you're going to take in order to see it. Then in every case, it's rebounded pretty aggressively from that bottom. And, this is the behavioral side that I think, I want to bang the table on. This is where you might want to start thinking about allocating if you have it, right? If you believe that it's normally distributed, you believe that it's going to revert back to its mean, it might not be a bad idea to start seriously thinking about allocating here.
This is where you earn your premium, right? So if you're going to earn it, are you going to stick around and get paid for it, right? I also like to think about with these trend and carry strategies. I think it works for others as well, but I just bring it back to middle school science. It's potential energy and kinetic energy. Kinetic energy is when you're getting when the bets that you're making are paying off, right? But in carry, we're building potential energy as okay. You're in bonds because they've got high rates versus cash. Well, there's a loss on that position, which means that rates just went up. So now you just took a loss, but your expected return is higher, right? And so you've got this sort of negative kinetic energy translating into potential energy. And so the potential return on the portfolio is probably considerably higher now because, the rate differentials have widened, the slope of the yield curve has steepened, et cetera. And so you just have to wait for this potential energy to translate into kinetic energy once it's unleashed in, the next regime, right? It really is just a waiting game. This is where you pay and the payoff happens later.
Yeah. Look, just to kind of wrap things up, any parting words from any of you as to, how to kind of help advisors talk to clients with regard to this type of environment with rapid policy shifts? We talked a little bit about no pay, no premium. Any other
Well,
thoughts?
I have one thing, and somebody mentioned it about, how much trend versus carry would you recommend in a portfolio, right? And in general, we have about the same expectation for both. At least I do. I'm not sure whether everyone will come down in the same exact place, but I have about the same expectation for both, especially over, a 5 or 10 or 20-year investment horizon. I have about equal expectation. So, and what's great is that they're uncorrelated. They're reacting to different information at different times. And so, I always say if you own trend, you should 100% also own carry. There's tremendously good diversifiers for one another. It's like having two eyes and being able to view things in 3D through binocular vision. You're getting information from the term structure, you're getting information from price momentum, and together it's just a really fine, well-crafted dish. And the experience of them together is just so much smoother and more palatable than holding either of them on their own.
Yeah, I have a tremendous amount of sympathy for advisors who particularly have line item sensitive clients. When any line item goes through a big one-day drawdown, they've got to field calls, right? And you can't rent conviction, right? So if an advisor isn't truly understanding what this strategy is, I understand the desire to get out of it. And frankly, I felt the same way yesterday looking at our, the carry strategy. We eat our own cooking. I have a substantial amount of my portfolio has a carry overlay. But to Adam's point, I also have a trend overlay. And I have other overlays that I add. I have a huge amount of overlay on my core stock and bond position. Carry is just a slice. And somehow, despite substantial losses in carry yesterday, my PA was positive.
Yeah.
right? And so I go back to, even I have to check myself. Like, I can become over line item focused, but at the portfolio level, like, diversification worked. It wasn't fun to have that part of the portfolio down, but there was other stuff that was substantially up that net offset it because I wasn't so dramatically overweight that one particular trade. And so again, it is one risk premia that we have high confidence in, but it's one of many, right? And it's one that is going to operate well or not well in different environments, the same way stocks and bonds operate well and not well in other environments. Trend may operate well and not well. And for me, trying to market time or determine when these things do well or not is totally undermining the potential benefits of diversification. And when you have diversification across a huge swath of different strategies, the hurdle rate for market time just goes up so much. And so for me, I just go back to those basic principles of, do I have conviction in the strategy long term? Is it appropriately sized in my portfolio? Yesterday was a great test, and for me, it was. And what else do I have next to it that I do believe is truly diversifying? And did it behave in a diversifying manner? And so I looked at my PA yesterday and said, did exactly what I thought it would do.
Yeah. And again, I think what we've seen is that these strategies are non-correlated to equities, bonds, and themselves in the last 3 days. And we've certainly, like, look, another acute moment of pain for managed futures was during the SVB fiasco, right? The Silicon Valley drop. Trend it was just caught really offside. Carry was not. It was a non-event for Carry, slightly up, I think, during that period, right? So again, it can be the opposite. Right now, Carry's struggling more than Trend. And that's what it is. It's added diversity across different areas of your portfolio. And they all tend to have a positive expected return, and we're going to meander around that over time in different ways, which is exactly what we're looking for. Okay, so with that, sorry we weren't able to get into any fund specific content here. We are restricted from speaking to any, with regard to the funds due to regulatory restrictions, but I hope that this was useful in providing some context on the macro environment and the kind of managed future strategies that are out there. If you do have any questions, you can reach out to us directly. You can go to returnstacked.com and go to the contact section and talk to any one of our reps. If you want to go directly to us, we are on Twitter and pretty active there, or LinkedIn these days. So look us up. Corey is at Hoffstein. Adam is at GestaltU. And I am at Rod Gordillo P. All right. Any parting thoughts? Adam, I know you needed to go 15 minutes ago. Thank you for sticking around. Thank you, everybody, for sticking around this long. Really appreciate your time today, and looking forward to seeing you in our next live Q&A.
Thanks all.